Well, good morning, ladies and gentlemen. And as we are each week, we are back live with Dr. Andrew Wilson. Good morning, Doc.
Yeah, good day, Graeme. I'm down in Melbourne today, and gee, it's chilly, 3 degrees for most of the day, I think. But
Already.
Thankfully, a nice heated room here, studio, but it's very cold. In fact, I think it's going to be the coldest day in 25 years in Melbourne. But it's sunny. I'm not sure the sun counts for very much when it's just 3 degrees. So,
well, look, to shed a bit of light on it, the Gold Coast, I've been wearing jackets the last few days. It's not much warmer. So It's not, you're not the only one, although it's a lot colder down there.
It's a lot colder, mate. But I've got the big jacket, the beanie, the gloves, the scarf, you name it. So when I go out, I can just about tolerate it.
I love it. Well, I'll tell you what's not cold, Doc. The Australian property market.
No, Graeme, we'll look at the results from last weekend's return to the full market. Of course, the weekend before we had I was nearly going to say the Queen's birthday. It was the King's birthday holiday weekend, or the Monarch's birthday. What do they call it? But so we had the market back up and running everywhere, of course, except Brisbane, which didn't have the holiday. So it was interesting to see just how the market would react after the pause. Now, let's really focus on the time of the year, Graeme, because we are coming to the end of the notional autumn selling season. It does run through to the end of June and maybe into July, and then the market loses focus, of course, for holidays and starts thinking about buyers and sellers start thinking about a spring campaign. So it will be interesting this year to see if we get that normal shift in focus, that normal easing of market activity, perhaps some early signs already, but because the market has been so strong over the past couple of months, and whether that momentum will move into what is normally the quieter period of the year. I think it will, but I think we're really primed for a strong spring selling season. And all the economic factors continue to point at a strong economy, Graeme. We'll look at that today as well. And some interesting signs overseas in regard to interest rates, Graeme. We've got the US have put rates on pause for the first time since they began tightening them last May. And New Zealand, which unfortunately for our brethren or our comrades over the ditch, they're in a recession now. They've entered into an official recession, and their central bank has said that they're not going to raise rates anymore, that they're done. But their rates are over 0.5% higher over 1% higher than where we are at the moment. So, a few questions about the policies from the New Zealand Reserve Bank and Central
Doc,
Bank.
I noticed, Doc, in the minutes being released from Australia's Reserve Bank, there's some interesting commentary for the first time in a long time around the psychology of consumers, because they made a lot of comments that they were this close to pausing at the last rise, but they were talking about the psychological effect that would have on borrowers and all that sort of jazz. So I'm finding that interesting now. They're not necessarily even talking about economic policy anymore. They're talking about psychology at the Reserve Bank.
Well, where was that discussion in April when they paused? What? The word, the term flip-flop.
They could have just gone 0.5% and be done with it and scared people if we're going to look at the psychology of it all.
Exactly, Graeme. And, as I said, they're a little bit all over the shop at the moment. Their commentary on making the decision a couple of weeks ago to raise rates again in June was certainly seemed to have a harder tone to it than recent in terms of its determination to tackle inflation. And but as I said, since then, of course, we've seen the international scene changing slightly. That's not to say that they've controlled inflation, because they haven't, the US or New Zealand, but I think they're wary of the consequences, the potential downturn consequences of higher rates. So they're wanting to give everybody a bit of a break. But I'm a bit of a believer is you go and you go until you can stop. Not you go, you stop, you go, you stop, I'm not sure that achieves much. And I'm not sure it's a good, confidence tick for central banks when they're saying one thing 1 month and then they're saying something else the next month. So interesting times we live in, but there's no doubt that our economy is still roaring along, Graeme, and we saw that with the latest unemployment data that was released. The May data was released last week. This was going to be a very important data set because if we remember, the month before we had a first real sign of easing of our economy with unemployment rates rising and employment falling and unemployment rising. But, we've now got to have a real close look at those ABS statistics, Graeme. I think we've now got to take them with a grain of salt and particularly around the seasonal adjustment factors because, as we'll see shortly, the data for May was very, very strong again. So I think that perhaps May's data was a little bit too strong and April's data was a little bit too weak. So, but nonetheless, you can only, I suppose, go on the official data, but I do think the ABS is having a lot of problems with their seasonal adjustment. They even mentioned in in their commentary regarding the labour market that they were, that the lower result in April was because of holiday distractions. Hello, that's what seasonal adjustment's supposed to do. The weak months are made stronger. The holiday months are made stronger and the non-holiday months are made weaker, to get everything balanced out. It's like a handicap in a race, Graeme.
It's a bit funny, though. We're going to call it seasonally adjusted to adjust and handicap for that ebb and flow. Then we're going to make commentary about adjusting for the adjustment. Like, come on.
Yeah, that's right. That's right. What? So is this the seasonally adjusted seasonal adjustment? Yes. So is this the seasonal adjustment of the seasonal adjustment, right?
They could have been wrong and they were right about being wrong.
Yeah, that's right. So my head is spinning. But, this is look, I'm a little sympathetic to them because everything's been turned upside down through COVID. COVID, we had weak months which were supposed to be strong and we had strong months which were supposed to be weak. And that was because we were coming in and out of lockdown. So it's going to take, because, seasonal adjustment models are pretty logical and basic. It's not real rocket science. They just, over a period of time, look at the averages and look at those months which move below the average and they say, okay, we've got to give them a lift. We've got to adjust them upwards. And those months which are above the average, the adjustment process pulls them back downwards. And that's the seasonal adjustment process. But you've got to have a robust average, Graeme, to work on. And this is the problem when we're looking back, a couple of years to get those averages. They're being affected by COVID, which was still, a big issue in 2021 in terms of lockdowns affecting activity. So I'm sympathetic to them, but what it means is we need to take the figures with a grain of salt. And one way of doing that is looking at the raw data, the original data, and then comparing it with the same month last year, the year before, and just seeing what the difference is there. And that gives us another sense of exactly what the numbers are, stronger, weaker, the same, But nonetheless, you can't discount what is still a very strong economy.
Yeah. Well, let's do that, Doc. Let's look at some data and see what is, I believe, not so cold. The weather is, but the market sure as anything is pretty hot.
Yes, the market, the economy, it's all working together, Graeme. So my housing market, latest data for the weekly update, always the first with the latest. We are here, Graeme. We try to be. We've got some interesting data today, got a fair bit of data, so we'll need to move it along. So the economy is still booming. We've alluded to that already. The latest labour market data saw the unemployment rate fall to 3.6%, Graeme, down from 3.7%. Of course, that's just a tick upwards from the record low 3.5%. As we say every month, we haven't seen unemployment rates in the threes since the early 70s. And that's when the measure for unemployment was taken over 3 months, not over 1 month. So these are record lows for the monthly surveys. But comparing, where we are in 2023 with way back in 1970, is really oranges and apples here, because it was a completely different economy and a completely different Australia then. We were basically a single income household. It shows just how much stronger really these numbers are than back then, because we're now accounting for many more incomes per household to provide, to have jobs. And we still have an unemployment number very, very low. In fact, at record low levels. So down following the increase upwards. Of course, we moved from 3.5 to 3.7 the previous month. Now we've gone from 3.7 to 3.6 this month. As I said, a little bit of issues with those seasonal adjustments, Graeme, I think. All our states are recording low unemployment rates. Look at that that New South Wales result, which of course will reflect Sydney, just 3.1% unemployment rate in New South Wales, Graeme. And again, when we look at the comparing it to a year ago, you can see that all our markets, with the exception of Western Australia, which had a crazy low unemployment rate last year over May, are lower than where they were a year ago. And they're all in the threes there. So there's no outliers really, Graeme. Very strong results for all the states. And I think it's that consistency in economic performance, which is also translating into a consistency with housing market activity as well. So good numbers there for the state unemployment rates over May. And just to move through the actual data, the jobless fell back to 3.6%, as I mentioned, near record low. Look at this, Graeme. Jobs were up after falling in April. Jobs were up 76,000. 76,000 jobs were created over May. That's a huge number. Now, these are seasonal adjustment numbers, Graeme. Let's remember. So, grain of salt here, please. But nonetheless, a very, very strong result, 76,000. And the unemployment number, after increasing over April, bounced back for a decrease of 18,000. So 18,000 fewer people unemployed over May. So again, this is probably a little bit too high, these numbers, and the April numbers were probably a little bit too low. Reserve Bank has conceded those issues with, it's conceded that there were holiday factors that affected the lower April numbers. But, given they're supposed to be seasonally adjusted, I think that's a bit of an issue which we've discussed regarding the problems with COVID, how that's changed the seasonal adjustment. So, and I'll tell you what's interesting, Graeme, we've got the retail sales coming out next week. So that also has been flatter over April, and it'll be interesting to see whether that bounces back, similarly to how we've seen the unemployment data or the labour market data bounce back over May. Maybe we'll see a pickup in retail sales. Interesting if we don't, because that'll be a sign that the economy is maybe feeling the pinch slightly. But the participation rate, which of course measures the proportion of the population that are in the workforce, it fell in April just marginally, but bounced back up again to that near record high, 66.9%. That's what it bounced back to. So still, we're still, providing just about everybody in the population who wants a job with a job. As we saw, most of the states reported very low unemployment rates and below where they were a year ago, with the exception of Perth, Western Australia, which had a ridiculously low 3.1% a year ago. But rate increases on this data clearly have had no impact on the economy, Graeme. And I mean, this is the point. This is the theory that the way you stop people spending and pushing prices up is to stop them having a job, and that hasn't worked in terms of stopping them having a job to this point of time. And we've raised rates now. We've been in this increasing cycle for 13 months, and we've raised rates, 12 times. So, it's actually 14 months, but we've raised rates 12 times and, nothing's happened. Nothing really has happened. And certainly.
We know what has happened. Property values have increased.
Hello? What? Are you kidding?
Actually, I reckon just before rates started rising, a year and a half ago, when you and I were talking about this, and we kept saying with COVID, this correction's probably not as deep and as steep for anyone who's been tuning in, listening to earlier episodes. So if there is a correction coming, it's not as deep and as steep as predicted. It's not that bad. But we also talked a lot about when there is that correction of, 4 and a bit last year, 5%, depending where you were.
Yeah.
You talked a bit, Doc, about the fact of rising interest rates and that, usually settling home values. A couple of times in those old episodes, you mentioned that, say it comes down 4 or 5% when rates go up. You talked a lot about when that fear subsides and that psychology that you said that when it does increase, when rates come down, it actually values increase a lot quicker than they went down. So when rates are up, values drop a bit. But you talked a lot about when rates go down, values increase, in contrast, but they do it a lot quicker. Talk a little bit about that, Doc.
Well, it's about pent-up demand, Graeme, because those that were in the market in terms of buyers and sellers, when they get the fear campaign, foisted on them, we've seen this. We saw this in 2018. It's a bit of a rerun of that when there were those crazy predictions of house price crashes, which is probably the worst fear environment we've ever had in this country, I think, in terms of the housing market that wasn't substantiated because there were no interest rate increases then. But you see buyers and sellers, they sit on their hands, Graeme. They say, oh, this is a bit scary. That's the fear factor, right? No, not doing anything. Oh, my God, prices are going to crash. Just listen to the media, right? So they sit back. So those that were, naturally in the market, they postpone their decisions. So that creates pent-up demand, right? It's like, the housing market demand is just a river that constantly flows, right? It's just created by all those factors we know, household formation, migration, etc. So it's just a river that's flowing. But when you get the fear factor, it puts a dam over the river, right? And so it all builds up behind the dam. All that demand builds up, right? Because it can't get through because the fear is stopping it. But once the fear eases, now it's not necessarily easing because of higher interest rates creating the fear and then lower interest rates easing the fear, because we've still got interest rates rising, Graeme, and we've seen prices growing since February, and yet since February, we've had 3 interest rate increases, right? And in fact, we've had 4 interest rate increases. So it's not about, interest rates falling. It's about people just saying, no, this is nonsense. I'm getting on with the business. Well,
Doc, not only you're accurate there, but it's a bit of a loaded question, because I guess where I'm going with this now is we're going, forget the dam's there, the pent-up demand's there. It's getting harder and harder to get a home loan approval or investment approval. If the dam was there and we're still got this pent-up demand being released, what are your estimates of what's going to, in a labour market as strong as what we can see on screen now, or those listening at home of what you've heard, what's going to happen if rates start coming down?
Well, that's right, Graeme, because rates are going up and we're releasing that demand now. That pent-up demand is being released. And you see, the other factor, Graeme, is as that pent-up demand is created at the back of the dam, prices ease, right? So eventually what happens is, those in the market who are perhaps a little bit more aware of the nature of our housing markets, the long-term resilience, they start to think, hey, this is a pretty good time to buy because prices are actually lower than where they were, before we put the dam over. So you get that sort of value opportunity driving the market. And that starts with just a little tricket, but that's weakening the dam, you see. And then it starts to flow out. And that's what we're seeing now. And once the flow starts, you get FOMO, fear of missing out, because people say, they notice houses are selling again. Prices are rising again. There's 10, maybe more bidders at every auction for most properties. Clearance rates are skyrocketing. And they start thinking, well, if we don't buy now, we're going to miss the boat and have to pay more. And that is exactly what's driving the market, I believe. Now we've had some strong results this year in some markets. Most markets are rising. In fact, all markets are rising. But Sydney's the best performer, and yet Sydney was the worst performer when the market started to ease a year ago, or more than a year ago, 18 months ago, following the big boom, post-COVID boom. But, Sydney's now just 4% below where it was a year ago. And this is my point, Graeme. Most markets are still, even though they've been growing, and even though Sydney's increased nearly 5% so far this year, right? And that's over 6 months. So it's on track to capture the 4% that it's still got to make up. And this is the point to buyers are thinking, hey, I can still purchase a property here and I'm getting it at a discount, regardless of those higher interest rates. And my wages are increasing at the fastest rate in 10 years, maybe 5, maybe 10% a year for some. And that's covering those bases. And of course, a lot of people don't have big mortgages when they buy, and they're getting all the encouragement because people are there wanting to buy their house, right? Or their unit. They're there, so they know they can sell. Now they've just got to find that. And that's gradually building this momentum, Graeme, that's been the cause of the rebound. But if we do get an interest rate cut, that's the end of the dam, mate. See you later, damn. And that's what we see, and then we get very strong growth going forward.
Even a pause, Doc. A pause is going to have a couple of leaks in the dam.
Exactly. And I think that the April pause from the Reserve Bank added some momentum to what was already reviving housing market activity. And, we are in the seasonal, as we spoke about earlier in the show, we are at the seasonal changeover. We have 2 selling seasons in the year: autumn selling season, spring selling season. August and July, particularly July, are the changeover months when we change from autumn to the spring selling season, and we're right just about there now. So it'll be interesting to see what happens. Of course, if we have some easing, we'll probably get the usual suspects saying, oh, this is the end of the world again, but it's not. And then they'll have to, disappear back, spiders back to their caves when spring revives. But that's an essential part of the dynamic, Graeme, as you mentioned. We are now seeing pent-up demand released that was created a year ago when the fear factor was very strong in the market as rates increased for the first time in over 10 years. We're now seeing, because we really saw, as you said, a very shallow a shallow downturn, because markets showed clear signs from September onwards of improving, Graeme. It was with higher clearance rates, and the rate of price decline started to ease, and it was a logical transition from there to prices increasing again. And now we have boom time clearance rates in Sydney and nearly in Melbourne. So it's going forward now. Once we get that dam released, we are going to see all that pent-up demand released, and it's got the support of higher wages to push prices up. And if we get lower interest rates, that'll only add to the capacity to push up prices in what is still a booming economy. So, we've still got some uncertainty going ahead, Graeme. We need to get rid of inflation. I think perhaps reserve banks are becoming, a bit more accepting of higher inflation for longer than higher interest rates for longer,
Okay. Well, labour market booming. I hijacked that a bit. Sorry, Doc, but I'm just
No.
felt it relevant.
Yeah, and it is important because this is the point. We're not seeing any change. Nothing's changing here. The question would be, if we hadn't have raised interest rates, what would be different? Well, we'd probably have higher prices, that's for sure, because we wouldn't have put the dam over the river. But we're now seeing that sort of adjustment from lower prices into higher prices, and that will probably accelerate, going forward. But the question is, what happens when we get to peak prices again, which I think we'll do most markets by the end of the year. Then we have to rely basically not on the discount factor, but wage increases. And the question is, will we have that offset by higher interest rates between then and now? I think we've only probably got a couple of interest rate increases ahead of us, Graeme, but the data will reveal that. I just think that the Reserve Bank's appetite to have a lengthy period of higher interest rates has, just starting to wane a little bit. So the other big data out last week, Graeme, was migration, and that's part of the story, of course, for housing markets. I mean, migration is not about the dam. They just come here, mate, and they've got to live somewhere. We saw, this is the latest data which was released last Thursday, and it's a little backward looking. It's December quarter. We do look at overseas arrivals, Graeme, from time to time, which is a bit more timely. That's a monthly data set. But this still gives you the big picture in terms of the real, and that's just about visas, that overseas arrival data. But this is about, the net position of Australia's population. So overseas migration is booming. Look at that data, Graeme.
Wow.
Yeah, no surprise that Melbourne, Victoria, is now leading the pack in terms of migration. They're the black line at the top. In fact, they're now, of course, it's a lot of catch up going on, but they're now rising or having net estate migration or annual migration. Sorry, this is total net migration. So it's the difference between people coming in and leaving. And Victoria is now at the head of the pack. And just below New South Wales. So, again, a very important factor in housing market activity, particularly rental market activity, Graeme. Very strong population growth as a result of net migration over, and that's the year to December, right, that we're measuring. And you can see the big hole there that happened as a result of lockdowns when we closed our borders. And now we're certainly making up for lost time. Look, the angle of the increase is just about the same as the angle of the decrease during lockdown for Victoria and New South Wales. Interestingly, Queensland's still up there. It's never a strong a state, and these are actual numbers. And of course, it's a smaller state than New South Wales and Victoria in terms of its population size. But Queensland's still up there. And of course, this is year. So this still reflects a lot of that interstate migration that Queensland benefited from during lockdown, as all those, I guess we could say, lockdown refugees moved out of Sydney and to a large degree, Melbourne. So this is the position. New South Wales, when we look at overseas migration, so this is net overseas migration, absolutely skyrocketing numbers there. 130,000 plus net migration over the year, and 120,000 in Victoria. Victoria usually is the leader for net overseas migration, Graeme, and we'll probably see that eventuating. But this is a very big number for New South Wales. Again, reflecting those terrible rent increases we're seeing in the Sydney market, I believe, is all about
absolutely
these migrants wanting somewhere to live. Queensland's still the top for interstate migration. And, of course, that still reflects that COVID lockdown period. And we will see that ease over coming months when we get the next set of data out. And there's still losses out of Victoria there, just under 10,000. But that's way below the 25,000 they had over the previous period, Graeme. So they're also moving, it's rebalancing, of course. People aren't, fleeing Victoria into Queensland at the same rate, and that's just adjusting. And as I said, this still does cover part of that COVID lockdown period. So big numbers there for migration, Graeme. Of course, it's an important factor in what's happening in our housing markets, particularly in our rental markets. Maybe not so much in the buying market, but that will come. And because a lot of the buying is occurring in mid to higher price sections of our Australian housing markets. And of course, that's not really the migrant demographic, but that will come. But I think, we're really seeing a surge in demand for rental properties as exacerbated by, these very big migration numbers. And this isn't going to change, Graeme. They're not going to say, we better ease back, whatever. No, they're going to continue to look at the demand that migration creates, and just think, let the cards fall where they do, because there's really no way to fix the terrible undersupply we have in housing in this country. So more rents. So we can see that the interstate migration for Victoria, the net interstate migration, how that's easing now as we come out of lockdown. So we're going to have a very, very fast look, Graeme, at the top regional markets, which we do every month. First here with the top regional markets. I've just focused here on the best performers over the past 2 years. So, those that are interested can get the copy of this presentation and look at this in some leisure.
Dubbo and Albury, woof, and Wagga, look at that.
Yeah, big numbers there in terms of the top performers over 2 years. I think that reflects that they're markets which have good value. If you look at their medians compared to the others, I think they've increased. And as I said, we're looking at the 2-year performances today, just to show that those value perceptions or opportunities eventually even capture people are pushed out of a particular higher priced markets, and those that are looking for opportunities, investors particularly start looking at those more affordable markets, which do traditionally offer higher yields, but they become undervalued. And plus, of course, those that are moving out or have moved out as a result of the COVID issues look for the affordable opportunities. But and even locals, Graeme, are driven by the fact that they've got higher wages. And they can pay more for property. But, in New South Wales, we've seen there the lower priced markets, some very strong results over the past 2 years. Victoria, the results aren't quite as strong in Victoria for the top regionals there with Bendigo, Latrobe and the Surf Coast. Again, Bendigo, mid-priced market, Latrobe, a lower-priced market. So there's not that same drive that we saw in New South Wales, but we know prices, when we reflect on the Sydney market, are higher in New South Wales than in the other capitals. But I thought it was interesting that the Surf Coast there has had a very strong result over the past 2 years, Graeme, and that's a high-priced market and it's a real boutique market, if I could call it that. The Surf Coast down, south of the Bellarine Peninsula, areas such as Lorne and Torquay and Ocean Grove, have become very popular with those that do have a flexible work environment. And I think that reflects those big numbers, or certainly the strength of that market. But, Latrobe, good value, pushed up prices there, again, similar to what we saw in New South Wales. And Bendigo is really sort of flexing its muscles at the moment. It traditionally tracks Ballarat. Ballarat locals won't be too happy to see Bendigo up and running above them by those sort of margins in there. But they're not too far away in terms of the median. Queensland, again, look at these numbers in Queensland, Graeme, over the past 2 years. Bundaberg, 40% higher. Fraser Coast, 42% higher. And Noosa, which had a real COVID boom, up, over 40%, nearly 50% over the past 2 years. And look at that Noosa median, 1.2 million. Graeme, very strong results there, and Toowoomba also with some strong results. So again, value and COVID have driven those markets, and the smaller markets there. We like to include our smaller states, Graeme, and we can see there that in Tasmania, Glenorchy and Launceston have had the best results there. Good result there for Launceston, 16% increase over the past 2 years, and Palmerston is just ahead of Darwin there in terms of its performance. So we do the regions as well. It's not just about capital cities here, Graeme. So, if you're in a region, you can get a feel for how your markets are performing. And we might do a regional rent report as well coming up, just to show how rent markets are performing in those major regions. So, as we start to wind up, we finish up as usual with our weekend auction market activity. And as I previewed earlier in the show, it was a bounce back weekend. The weekend before last weekend was the Monarchs, the King's birthday holiday everywhere in our major auction markets except Brisbane. So we had sort of obviously results which were affected by holidays 2 weeks ago. So this was the market rebounding or coming back in full. And as we always do, you can see why we use auction results, weekend auction results, because they're a terrific forward indicator of what's happening in the market. You can see there how Sydney prices clearly track auction clearance rates, and the same thing in Melbourne. So keep your eye open for auction clearance rates. They'll tell you how the market's performing, not just up or down or sideways, but also at what rate the market is performing as well. and its potential for recovery too, I think, is shown in where the level of auction clearance rates are. The market's generally bounced back following those distractions of the previous weekend. More positive results for most sellers, Graeme. And, of course, the booming Sydney market produced another clearance rate above 80%, following a similar result 2 weekends ago. So we've had 2 out of 3, Graeme, above 80%. You called it a couple of weeks ago, and you're spot on. And it was only really the holiday pause that we haven't had an 80% clearance rate. So let's see how we go for the last June auction weekend, which is coming up this weekend, and whether we'll start to see a little bit of that winter freeze coming in. And I don't mean the temperature.
I actually got a couple of messages on social media, Doc, telling me I was a moron and there was no boom coming in Sydney. I said, well, I define boom, the word, as 80% or above clearance rates. And I said, I reckon you'll see them week on week on week for the next few weeks or months. And here we are. Maybe I was an idiot. Maybe I was first to claim it. I think I was first to claim it.
Graham. And there's no doubt that there's some consistency there. We've been really close to 80% for the best part of 2 months in Sydney. So I guess you were just looking at the trend rationally. And when I
get to sit here with you each week, Doc, and I look at the data and you give context to the data. And every single week I can see if it's trending up, down, or indifferent. So, guys, please Doc, you say sort of take a scientific, data-driven approach to where you're buying, selling, exploring, etc. It's not that hard to follow if you invest a bit of time in this. Each week, Doc's giving you the data for free. I try to make it a bit interesting and a bit funny and make sure it's relative to our listeners and community. But the data, Doc, for me, I sit and go, I can see a trend. I can see what's happening.
Yeah, and we try to provide as real-time data as we can. So it's not about looking backwards. And our data sets, I believe, are very robust and resilient. They're well planned out. And I think that's why you see that they cover, not only are we the first in the market, but I think we're, as accurate as anybody else. And in fact, maybe more, but that's always an argument you have between your competitors. But I think that's the point. You clearly see the trend. And that's what we're trying to do, is not just look at prices, whatever. We like to have a correlation of factors, not just the data, the price data, auction clearance rate data, days on market data, etc., but also the drivers of the market. And that's what we've looked at today, the economy and migration, which are clear drivers. And is it not a surprise that we're talking about that Sydney market there, that, Sydney's got these, this now a consistency of 80% clearance rates, plus clearance rates, but it also has near record low unemployment, and it's the strongest capital now for international migration, so and remarkable numbers. So these are obviously factors. And of course, in terms of the buyer and the seller, the prices are still below where they were a year ago, and that booming economy is also creating very strong wages growth that is helping to offset those higher interest rates. So this is the data from last weekend, Graeme. You can see 500 auctions in Sydney, which was, pushing up towards 200 more than the weekend before, 81.9% clearance rate. And look at last year, the same post-holiday weekend last year, Graeme, we had 59.6% clearance rate. And, of course, that's when the fear factor was hot as hot, and people were having the hell scared out of them because of predictions of 20% price falls, which, of course, didn't eventuate. So look at that. That's a remarkable, 20% more difference in clearance rates just a year later. And if you had told that to people, saying we're going to get an interest rate increase every month except one from now until June next year, and our prices are going to be rising again, and our clearance rates are going to be at boom time levels, they'll say, no, you're crazy, mate. We're going to take you away. But that's the results. Now, Melbourne, very low numbers over the holiday in Melbourne, Graeme, just 253 auctions. But Melbourne typically loves a long weekend, and they vacated the auction market more or less over the holiday, but roared back last weekend, 622 auctions, and quite a solid clearance rate, 75.4%, perhaps a couple of percent lower than we would have expected, but still a very good result there for sellers and still pushing up towards that 80% result. Brisbane are now another good result, despite a big lift in auction numbers in Brisbane, over 20 auctions, increase in auctions, and a 68% clearance rate. These clearance rates that Brisbane are getting now, Graeme, and we discuss this every weekend, are now looking like, the strong results they got, during that exodus, that migration exodus that fueled the market in 2021. We typically see clearance rates in Brisbane around about 50%. But when we get over 60% in Brisbane, something's happening. And we can see that with other data points, price rises in Brisbane now. And that market looks like it's up and running again. And it was the strongest market, or the last market, it and Adelaide were the last markets to ease last year, and their booms continued on. But now it looks like, again, it's going to be a very shallow correction period for Brisbane, Graeme. And these results are quite strong. Adelaide has just tracked back a little bit over recent weekends. We can't be sort of knocking the Adelaide results. 75% is still a seller's market, but it's below those 80% results that it has been getting. And Canberra also down a little bit over what it's been, its revival that we've noted over over the past month or so. But again, just a handful of auctions, Graeme, just 32 auctions. So not a lot there to base what's happening in the market. So a good result there for our auction markets coming back after the holiday. As I said, we're now entering or getting close to, a couple of weeks away, a week away, who knows, the winter selling season, which is obviously a subdued period of the year. It is the bridge between the stronger parts of the year, the autumn selling season and the spring selling season. And it'll be interesting to see if this momentum continues through the winter market, Graeme, which is typically when buyers start to think about a spring selling and sellers start to think about a spring campaign. So if we look at the month, we can see just how things have changed over the year. Sydney about 20% clearance rate higher compared to June last year, and this is the total to June. So that's 3 weekends clearance rates. Similarly, Melbourne well ahead of a year ago. Brisbane around about the same. So, and of course, as we mentioned, Brisbane was coming out of a strong period there of activity driven by the migration, interstate migration. Adelaide a little bit lower than a year ago, but still a strong result. And Canberra just ticked down a little bit over the last 2 weekends with low numbers, but still ahead of where it was a year ago. So you can get those auction results every Saturday evening for the snapshot of the capital city results at around about 6:15. And then on Sundays, you'll get the full national report with the regional breakdowns for Sydney and Melbourne and the top sales for all the capitals. And that comes through on Sunday mornings, later on Sunday morning. So look out for that one on my LinkedIn network. And next week, Graeme, we're going to have the June results for house and unit prices. So first with the news next week, June house and unit prices, and that'll cover the capitals. And we'll also look at the regions for the capital cities. So not the regions which were country regions we looked at today or non-capital regions. We'll see how the regions in the capitals are doing, right? So that's each of the capitals regions. We'll have a look at how they're going. What are the best performers there? And, of course, we'll look at the latest weekend auction results. So another big weekend in property, Graeme. Important economic data with the labour market for May, which again was strong. Well, not again, but certainly was strong. No sign of easing there, but some question marks over the seasonal adjustment process from the ABS, and of course migration, this is a flood of migrants, Graeme. This is unprecedented in terms of migrant growth. Of course, it's unprecedented because we're coming from nothing. It's like our interest rates started at nothing, our migration started at nothing. So it's obviously, but there's a lot to absorb there if you're looking for somewhere to live coming through. So
absolutely.
Next week will tell us what June did.
And ladies and gentlemen, if you're not following, I'm not a big LinkedIn user, to be honest. I'm bloody busy, and I know Doc's not an avid user, but he definitely publishes all of this data live pretty much within a day or so of producing it. So definitely tune into Doc Wilson's LinkedIn or stay tuned on the YouTube and the podcast with us. But as always, Doc, much appreciated, and we'll see you next week for another big week of data, I'm sure.
It will be, Graeme. Good on you. See you soon.